Click the bell icon to get latest videos from Ekeeda.
Hello friends, myself Professor Uday Bhokre. Now I am welcoming you on your own YouTube channel Ekeeda. Before we proceed further, I request you to subscribe to our channel and also press bell icon over there. Let us come to the topic Dissolution of Partnership Firm CA Inter course, and we are going ahead with the question number 4, Dissolution of Partnership. It is in your group 1, right? It is your accounts paper group 1. We are doing Dissolution of Partnership Firm and we are on question number 4. Question is in front of you right now. You can see they have given you P, Q, R and S had been carrying on a business in partnership, sharing profit and losses in the ratio 4:3:2:1. So it is their profit sharing ratio. They decided to dissolve the partnership on the basis of the following balance sheet as on 30th of April 2011. So it is the date of dissolution. Capital account of partners P and Q is having positive capital. General reserve is there 95,000. Capital reserve is there 25,000. Creditors 36,000. Mortgage loan 1,10,000. Asset side we have a land and building, furniture and fixture, stock, debtors, cash in and capital overdrawn is also given to you. So these people are having debit balance in the capital account. Assets were realized as under land and building 2,30,000. Furniture and fixture 42,000. Stock 72,000, debtors 65,000. The 4 assets are realized. Expense of dissolution 7,800. Further creditors of 18,000 are to be made. Means beside these creditors of 36,000, we need to pay 18,000. R became insolvent. R is insolvent, right? And nothing was realized from his private estates. Applying the principles laid down in Garner versus Murray rule, prepare a realization account, partners capital account, and cash account. So only 3 things are asked: realization account, partners capital account, and cash account. Okay. So firstly, let us prepare partners capital account. Sorry, realization account. First, we will prepare realization account, then partners capital account, and then cash account. So on the top of the page, you will write in the books of partnership firm. So in the books of partnership firm, first account to be prepared. First account to be prepared in the books of partnership firm. First account to be prepared is realization account. Okay. So we will prepare realization account. You know how to prepare it. Particulars rupees is the format. So this is how the format will be drawn. Here we will have a particulars. Here we will have amount. Okay, it is how you will draw your realization account. Next account to be drawn by you is partners capital account. So let's draw partners capital account here. So partners capital account. There are 4 partners, so 4 capital accounts will be there in a columnar form. particulars P Q R S rupees 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 PQRS rupees 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 rupees. In this way, you have drawn partners capital account. One more account they wanted is cash account. So we'll have one small cash account here. So one account to be prepared is cash account. Cash account. Particulars amount rupees particulars. This is how we have drawn three formats: cash account, then we have also drawn partners capital account, we have also drawn realization account. Okay, let's come to the question, students. Look at the balance sheet. As we know, assets will be transferred to which account? We will transfer it to the realization account. On debit side at its book value. So come on the debit side. Of realization account. This is your realization account. On debit side, you note down to sundry assets account. Sundry assets account. Note down all assets at a book value. These all land and building, furniture and fixtures, stock, data at their respective book value. So let us note down one by one. Land and building. The amount is 2,46,000. Then furniture and fixture 65,000. Stock 1 lakh. And data 72,500. We have to take a total of this in outer column. So let's take the total. 246,000 plus 65,000 plus 1 lakh plus 72,500. Your total is 483,500. 483,500. This is your total. Capital overdrawn is of R and S. So R and S, you have to go to the debit side of their account. On debit side of their account, you will write two balance brought down. So let us note down two balance brought down. R and S are having debit balances, which is 15,000 and 18,000, 25,000 and 18,000. Okay. Now these two partners P and Q are having credit balance. So I am writing here on credit side. by balance brought down, and your amount is 168,000 and 1,08,000. These are the two amounts we have written. Thereafter, there is a general reserve, capital reserve. These all are the reserve surplus which will be divided between partners in their respective profit sharing ratio. Right? So please note down by general reserve. The ratio between them is 4:3:2:1. So divide by 10. 95,000 divided by 10, that comes to 9,500. 9,500 into 2, I guess 19,000. $9,500 into 3, 28,500. 9,500 into 4, 38,000. This is how we have divided general reserve among the partners. In the same way, we need to divide capital reserve. So please note down by capital reserve account. How, sir, it will be shared? It will be also shared in the ratio 4:3:2:1. So 25,000 will be divided. So divided by 10 will make it to 2,500. So 2,500 here. 25 twos are 50, so it comes to 5,000. 25 threes are 7,500. 25 fours are 100, that comes to 10,000. Right? In this way, 25,000 were divided between these four partners. Creditors' mortgage loan are the liabilities which will be transferred to realization account on credit side at their respective book value. Come to the realization account on credit side by sundry liabilities account. Note down the liabilities one by one. Your liabilities are given. Sundry creditors 36,000. So sundry creditors 36,000. And mortgage loan. Mortgage loan amount is 1,10,000. 1,46,000. This is how we have transferred our balance sheet to the respective accounts so far. I hope transfer is not a big deal and you know it very correctly. There is no difficulty as such. Now let us see the information provided. They are saying assets were realized as under. So realization of asset is provided to you. So what would be your entry? Your entry would be bank that cash account debit, because we have maintained cash account, to realization account. So this is your entry. So cash account debit to realization account credit. So let us come to the first realization account. It is always better to give effect to the realization account first, and then we will give second effect in the cash account. So realization account on credit side, that is cash account debit to realization account. So by cash account, which asset realized at which value? Let's see in the example. They have given you that land and building is realized at 2,30,000. Next, furniture and fixture 42,000. Amount realized is 42,000. Next asset realized is stocks 72,000. Next asset realized is debtors amount 65,000. take a total of this. $2,30,000 plus 42,000 plus 72,000 plus 65,000. Is that 4,09,000? What is our entry? By cash account means, can I say cash account should be debited for this? So come to the debit side of your cash account and note down to realization account. $4,09,000. Okay. In this way we have recorded realization of asset. Then they have given you further expense of dissolution amounted to rupees 7,800. So please come to the debit side of realization account, note down to cash account. In the bracket you note down dissolution expenses. So amount of dissolution expenses incurred by you is 7,800. Okay. Next they are saying further creditors are to be met 18,000. Further means beside these two creditors we have to pay 18,000. So your creditors will be more by 18,000. So firstly the cash account should be credited for dissolution expenses. So dissolution expenses, firstly you give credit to the realization account by credit to the cash account by realization account 7,800. This is second effect of dissolution expenses we have debited to realization. Now we are paying to the creditors, realization account debit to cash account again. Firstly creditors given in the balance in your original balance sheet, sundry creditors. They are paid 18,000 more. That means there are further creditors of 18,000 beside 36,000. So 36,000 plus 18,000. Is that 54,000? Besides that, can't I say bank mortgage loan is also paid? $1,10,000. $164,000. So credit your cash account by realization account. $164,000. Okay, so this is how we have practically these partners may not bring the cash. This might be only a notional entry because ultimately at the end we transfer everything to the cash account. Okay, so this entry might not have a practical relevance, but this is done as per the Garner versus Murray principle. What principle says that? Principle says that deficiency of insolvent partner will be shared by solvent partners in the ratio of their capital just before dissolution. Just before dissolution. So dissolution से पहले का क्या उनका कैपिटल रेशियो है वो देखना पड़ेगा. In our case we have three partners P, Q and S. उनका हम लोग को देखना पड़ेगा क्या PSR आता है, कैपिटल रेशियो आता है, और वो रेशियो में कौन शेयर करेगा डेफिशिएंसी? P, Q and S. किसका डेफिशिएंसी शेयर करेगा? R का डेफिशिएंसी शेयर करेगा. Come to the working note we are drawing just below the cash account. We are drawing now here. Working note, calculation of capital ratio between P, Q and S, right? Before dissolution, of course, P, Q and S. Cast a glance to the credit side of these partners' capital accounts. So what we will say, credit total just before dissolution. So be careful. I will take only those amounts which were there before dissolution. Rather practical, let us take the help of balance sheet. What was their capital? So I can say opening capital. Opening capital they have given you 168,000. Second partner 1,08,000. Last partner we have a negative capital S. We have a negative capital of 18,000. Then they have shared reserves. General reserve they have shared capital reserve, right? So we will take addition of that. Add general reserve. See, this is general reserve what they have shared. So I am writing general reserve. How much shared by P? P shared 38,000. Q shared 28,500. And S shared 9,500. Right? Then they have also shared capital reserve. Capital reserve how they have shared 10,000, 7,500 here, 2,500. So 10,000, 7,500 and 2,500. So what is their last agreed capital as per the balance sheet? Last agreed capital. So in case of first partner, it would be 2,16,000. Second partner, it is 108,000 plus 28,500 plus 7,500, 144,000. Third partner, there is a negative capital. There is a negative capital. It is negative 6,000 capital. Rule says that deficiency will be shared in their last agreed ratio. In this example, Mr. S is having negative capital. So he will be skipped from our ratio. So he will not be counted. The ratio between these two partners we need to derive. Is 1.5. 1.5 is to 1. So make it 3 is to 2. So your ratio is 3 is to 2. Right? So if you can see that ratio is 3 is to 2. Ratio is 3 is to 2. So firstly, we have calculated the capital ratio between P and Q, who will share a deficiency of whom? R. Now let us find out deficiency of R. Working note number 2, deficiency of R to be shared. How you will calculate? You will say that total of debit side of R's capital account R's capital is 45,060. 45,060 minus total of credit side of R's capital. Credit side of R's capital total is 24,000. 24,000. So what is their deficit capital? Is 45,060 minus 24,000. 21,060. Any final payment he is giving, nil. So deficiency to be shared, shared 21,060. By whom? Who will share the deficiency? P and Q. So I will say P's capital account debit, Q's capital account debit to R's capital account. R capital account will be created with 21,060 and the ratio between these two partners will be 3:2. So 21,060 to be divided by 5 multiplied by 3. First partner will share 12,636 and 21,060 8424. It is how your deficiency will be shared. So what we can say, in Garner versus Murray rule, deficiency will be shared in the capital ratio just before dissolution. In this case, if any partner is having negative balance, he is skipped from sharing the deficiency. Importantly, lastly, we have collected cash from the partners for the realization loss. Debit effect of that is to be given in your cash account. Firstly, let us give that to partners capital account. PQS. P has brought that time 40,120. Q has brought 30,090. And S has brought that time 10,030. As I told you, okay, practically this cash they might not bring. So we will just make a notional entry of that 40,120 plus 30,090 plus 10,030, 80,240. This cash they might not have brought. See, we are giving second effect of this. Okay. Now let's come to our working. In this working, we have decided that this is how your entry for deficiency sharing to be done. Your entry is P's capital account debit, Q's capital account debit to R's capital account. So let us share the deficiency. I am writing in the red coloring for sharing the deficiency. P's capital account debit, Q's capital account debit to R's capital account. What we are sharing? We are sharing deficiency. P is to be debited with 12,636. Q will be debited with 8424. And R will be credited. And R will be credited by P and Q's capital account. We are making him share deficiency. His deficiency is shared by other partners and amount of deficiency shared is 21,060. Now here at this stage, if we look at the insolvent partner's capital account, his account will get tally on its own. So let's take a total of firstly R, who was insolvent. Let's check whether his account is closed. His account is definitely closed as at 45,060. So R is insolvent partner, his account is closed. Correct? Now let us see other partners. Other partners, depending on the case-to-case basis, whatever is the balance that will be taken care by your cash account. So please close other partners capital account. I think P is having credit side heavier, Q is having credit side heavier, right? But I guess S is having debit side heavier. So firstly, let us collect money from S. S is having debit side heavier. Total is 28,030. So 28,030 minus this. It is how 6,000 he is supposed to bring for his deficit capital. So he is solvent, but so by cash account, this is what final amount he will bring. This will be debited in your cash account. So in your cash account, you note down to S capital account. He will bring 6,000 for his deficit capital, right? And thereafter, other two partners, that is P and Q, are having credit side heavier, so they will take away the money. Let's close their account. Let's see what is their total. P's amount 168,000 plus 38,000 plus 10,000 plus 40,000 120. Will it be totaling to 256 120? 256 120. 256 120. From that you minus 40,000 120 minus 12,636. Your difference is 203,364. Q, let us take total on credit side 1,08,000 plus 28,500 plus 7,500 plus 30,090. 174,090. On debit side, minus those two amounts, minus 30,090 and minus 8,424. 35,576. 135,576. This is their excess capital which will be refunded. So I will write to cash account, and in the bracket I am writing refund. So cash account on credit side, please note down by P's capital account and by Q's capital account. So by P's capital account and by Q's capital account. P's capital account, how much money to be paid to P? 203,364. And Q will be paid 135,576. Let us close the capital account or cash account and let us see whether cash or bank account tallies. 495,240. In cash account there was an opening balance, two balance brought down that we have not yet written. 15,500. So your total will be 510,740. Tally. So students, I hope this cash account tallies, and hopefully your account also tallies. If there is any difficulty, please refer back to us. We will be happy to solve your queries. Thanks a lot for watching this video. Please subscribe to our channel and also refer to your friend. Thanks a lot.